You've done everything right. You saved, you avoided dumb purchases mostly. You didn't blow your money on random crypto coins with dog names. And now you open your banking app and you see it. $250,000 sitting there, not invested, not doing anything special, just parked. And instead of feeling proud, you feel this weird tension in your chest because part of you is thinking, I should be happy right now. But another part of you is thinking, wait, am I actually doing something wrong? Okay, yeah, that's literally a lot of people. And if you've ever wondered why money suddenly starts working differently once you cross a certain threshold, this video is going to mess with how you think about banks forever. Here's the thing. There's a banking rule that almost nobody talks about. Not because it's complicated, but because it only applies once you're already doing well. And once you hit around $250,000, that rule quietly changes. Not on paper, not in a brochure, but in how the system treats you. My name is Jay, and I spend way too much time thinking about how money actually works behind the scenes. If you're someone who's saving, investing, trying to be responsible, but still feels like the system isn't exactly built for you, hit subscribe and give this video a thumbs up. Because this one isn't about hustling harder. It's about understanding leverage. Now look, most people think banks exist to help them save money. That's the first mistake. Banks exist to manage risk. They're risk while using your money to make themselves more money. And when you have $2,000 in your checking account, you're not a client. You're a user. When you have $25,000, you're a slightly better user. At $50,000, you're tolerated. But once you cross roughly $250,000, you quietly become something else. An asset? Here's what most people don't realize. Banks don't see money emotionally the way we do. They see it statistically. According to FDIC data, the median American savings account balance is under $5,300. Even among households earning over $100,000 a year, the median liquid savings is under $40,000. So when someone walks into the system with $250,000 in liquid or semi-liquid assets, you're not normal. You're an outlier. And the system treats outliers differently. Now you might be thinking, okay, Jay, but money is money. The rules are the rules. That's what I thought too. Until I started noticing something weird. People with the same exact bank, the same exact accounts, were getting very different outcomes. Lower fees, better rates, private banker access, faster approvals, different loan terms, same institution, different treatment. Why? Because once your balance crosses a certain threshold, the banking rule shifts from protect the bank from you to protect the relationship. This is where it gets interesting. At lower balances, banks assume volatility. You might overdraft. You might close your account. You might need customer service too often. You might cost more than you're worth. So everything is automated, rigid, and fee heavy. But once you have $250,000, the assumption flips. Now you're statistically stable. You're unlikely to panic withdraw, unlikely to default, unlikely to churn. And more importantly, your money gives them leverage. Let me explain this with a metaphor. If you walk into a car dealership with no cash and shaky credit, you negotiate from weakness. They control the terms. But if you walk in with a briefcase full of cash and excellent credit, suddenly the tone changes. Same dealership. Different power dynamic. That's banking. At $250,000, your money becomes collateral for trust. And trust is everything in finance. Now, let's talk numbers for a second. Because this isn't just psychological, it's mathematical. Banks don't just hold your money, they lend it. Under fractional reserve banking, for every dollar you deposit, banks can lend out a multiple of that amount. Historically, reserve requirements hovered around 10%, meaning $250,000 in deposits could support roughly $2.5 million in loans. Even after regulatory changes, the principle still applies. Your money isn't idle. It's productive, just not for you. So when you hold $250,000 in a standard savings account earning 0.4%, you're making $1,000 a year. Meanwhile, the bank might be lending against that same capital at 6-9%. That spread, that's the business. And once your balance gets large enough, banks want to keep you. which means they'll quietly bend rules, fee waivers that aren't advertised, interest rate negotiations that aren't available online, access to products that don't show up on the website. This is why high net worth clients don't bank the same way. Not because they're smarter, but because the system finally reveals itself to them. Here's the uncomfortable part. Most people never renegotiate their relationship with their bank. They keep acting like customers when they've become partners. And banks are happy to let that happen because silence is profitable. Now you might be thinking, okay, but $250,000 isn't that much money anymore. And you're right in lifestyle terms. But in banking terms, it's a psychological line in the sand. Many banks internally flag accounts above $250K for relationship management, not publicly. Internally, it's also not a coincidence that FDIC insurance caps at $250,000. That number matters. It signals safety, stability, and seriousness. Once you're there, banks assume you're playing a longer game, and that assumption changes how they behave. This is where people mess up. They treat $250,000 like a finish line, when it's actually a negotiation point, because from that moment on, you're not supposed to ask, what can this bank do for me? You're supposed to ask, why is my money here? Let me tell you a quick story. A friend of mine, same income, same age, same city, had about $300,000 sitting in a large national bank. Standard checking, standard savings, nothing fancy. He complained about fees, slow wires, mediocre rates. So he did something radical. He asked to speak to a relationship manager. Not angrily, not emotionally, just directly. Within 2 weeks, all monthly fees gone. Higher savings yield, free wires, direct line to a banker who actually picked up the phone. Nothing about his money changed. Only his awareness did. That's the psychological unlock. Banks rely on the fact that most people don't know when their leverage changes, so they never use it. And here's the deeper insight. Money doesn't just buy things, it buys optionality. Once you have $250,000, your greatest asset isn't the money itself, it's the ability to say no. No to bad terms. No to unnecessary risk. No to staying where you're undervalued. But only if you recognize it, because if you don't, your bank will happily continue extracting value while giving you the illusion of safety. Now let's address the elephant in the room. Should I even keep $250,000 in a bank? Short answer, no, not blindly. Cash has a purpose. Liquidity matters. Emergency funds matter, but idle cash is a silent tax. Inflation averages around 3% long term. Many savings accounts still pay under 1%. That's a guaranteed loss in purchasing power every year. So the real question becomes, how much cash do I actually need and what should the rest be doing? This is where math meets psychology. People overallocate to cash because it feels safe. But safety isn't just about not losing money. It's about not losing time. If $200,000 sits idle for 10 years at 1%, it grows to about $220,000. At 6%, that same money becomes nearly $360,000. That difference isn't trivial. It's years of your life. So the action step here isn't ditch banks. It's renegotiate your role. Use banks for what they're good at: liquidity, payment rails, short-term stability, but stop letting them be the default home for long-term value. And once you cross $250,000, demand more. Ask better questions. Explore private banking options. Consider multiple institutions. Use money market funds, treasuries, or high-yield alternatives. Not because it's flashy, but because it's intentional. Here's the final mindset shift I want you to take away. The system doesn't reward effort. It rewards positioning. When you have $250,000, you've earned the right to reposition yourself from passive participant to informed operator. And the moment you realize that, money stops feeling like something you're chasing and starts feeling like something you're directing. That's when things actually change. Not overnight, not magically, but structurally. And that's the difference between having money and having control. If this video made you look at your bank account differently, you already know what to do. I'll see you in the next one.